Welcome to the deep dive. Today we're putting Hello Group, that's ticker MOMO, under the microscope. Their Q3 2025 earnings call just dropped, and it's a real head scratcher. I mean, they delivered this really decisive earnings beat, but then the stock just cratered, down over 6% on pretty heavy volume.
Yeah, that stock drop tells you everything you need to know, doesn't it? Our mission today is really to get past those headline numbers. We need to figure out what's going on with this divergence between management's vision, this big shift away from China, and the market's total skepticism.
Okay, so let's jump right into that paradox. They beat earnings, but the stock finished down 6.2%. Investors were clearly running for the exits. Was this just like a phantom victory, something driven by cost cutting that just isn't sustainable?
I wouldn't call it a phantom victory, but it was. Well, it was a victory that came at a very high price. If you look at the financials, they were disciplined. They definitely exceeded Wall Street's expectations. GAAP diluted EPS, it came in strong at RMB 2.06. That's about 29 US cents per ADS. That beat the consensus by around 14%. Non-GAAP was even higher at RMB 2.38.
That's impressive control on the bottom line. But we know the market looks at the foundations, not just, the paint job. Where were the cracks?
The top line. That was the first big crack. Revenue was RMB 2.65 billion or 372 million US dollars. And that was basically flat year over year. It was actually down 0.9%. So even though it kind of met expectations, the growth engine was clearly sputtering. But the bigger worry was the erosion of the profitability structure.
I noticed that. Yeah, the overall net income dropped pretty significantly, even with all those cost controls.
Precisely. GAAP net income was down a massive 22% year over year. It landed at RMB 349.6 million. And if you look at the margins, non-GAAP operating margin compressed. It went from 17% a year ago down to 15.2%. So yeah, cost controls helped them beat that EPS number. But the real story, the one investors saw, was slowing revenue and shrinking margins.
So the market saw a company that's getting leaner because it has to, not because it's strategically optimizing from a position of strength.
You've got it. And that margin pressure is the perfect link to the next big topic. The domestic business. The core China engine is where all the pain is concentrated, and it leads us straight to regulatory headaches.
Absolutely. The structural headwinds in China seem pretty severe.
They are. Mainland China revenue, which covers both Momo and Tantan, was down about 10% year over year to RMB 2.12 billion. And this isn't just a simple macro slowdown. Management pointed a finger directly at a big regulatory change.
Right. They called it the new tax policy adjustments for the flexible workforce. Can you break that down for our listeners? What does that actually mean for a platform like this?
Yeah, it's fascinating. It's basically the regulatory environment in China tightening its grip on the digital creator economy. Historically, the broadcasters and the agencies, Momo's entire content supply chain, they operated under these really flexible tax rules. The new policy changes all that. It brings a lot more scrutiny, more compliance. It treats these flexible workers more like a formal business that's subject to higher standardized taxes.
So the government is basically shifting the risk onto the broadcasters, who are the lifeblood of the platform.
Correct. It creates this taxation crisis for them. It distracts them. It reduces their enthusiasm because their take-home pay shrinks. So to stop them from leaving, management had to make a really tough choice. They increased the revenue sharing payout ratio, and that is a direct, permanent hit to their gross margins.
And they actually quantified that cost in the guidance, didn't they?
They did. Management expects that change alone to cut the group's gross margin by 1 to 2 percentage points for the entire second half of 2025. It's a huge sacrifice. That's the market's pain point. But it's also a strategic move to, keep the platform healthy long term.
Despite all that domestic pain, I was surprised to see a little glimmer of hope in the Momo app's user trends.
It's a small glimmer, but it's there. So paying users on the Momo app are way down year over year, from 6.9 million down to 3.7 million. But, and this is the key thing, they actually saw a slight sequential bump. They added about 200,000 paying users quarter over quarter. And that came from some clever product tweaks, like new gifting features in audio chat rooms and better AI chat assistants.
Which really confirms that pivot you mentioned earlier. This company is all about profit now, not scale.
Exactly. They're shifting their budget based on strict ROI, not just user volume. They know the domestic growth story is over, so now it's about optimizing the existing user base for maximum yield. They're trying to keep what's left of their cash cow business as productive as possible.
Okay, so if the domestic side is shrinking and fighting all these headwinds, then the entire investment case has to rest on the other side of the story, the overseas reinvention. And those numbers, they look well, they look explosive.
They are the counterbalance. Overseas revenues surged to RMB 535 million. That's a 69% year-over-year growth rate. This is radically shifting their whole portfolio. Overseas is now 20% of total group revenue. Just a year ago, it was only 12%. That's a massive shift in just 4 quarters.
And where is this 69% growth coming from? Is it all one thing or is it diversified?
It's pretty focused but strategically spread out. The main driver is their audio and video social products in the MENA region apps like Happn and Amar. And they're pushing those into wealthier places like the Gulf countries and also hitting East Asia hard, especially Japan, where high ARPPU social apps can really thrive.
So MENA handles the social side. What about the dating portfolio? Tantan International, for instance.
Tantan International is a really great turnaround story. The Singapore team did a full rebranding, adjusted the product, and for the first time in almost a year, it's back to sequential growth. It really validates their new strategy of localizing the international dating apps instead of a one-size-fits-all approach.
And speaking of dating, they just closed the acquisition of Happn, the European dating app from Paris. That feels like a major statement.
Oh, it absolutely is. It gets them a footprint directly into the European market, which is huge. But the strategy is even deeper. Management said they intend to relocalize high-quality Western brands back into the Asia-Pacific region.
Wait, why would a Chinese tech company want to bring a French dating app back to Asia? What's the competitive edge there?
It's about leveraging what Hello Group does best. High-frequency monetization, community management, live video, audio features, stuff that Western dating apps have been really slow to adopt. So they buy this proven brand and tech, and then they inject their sophisticated Asia-Pacific monetization playbook to accelerate growth back in the East. It's smart.
Okay, so to sum up the trade-off here, they're replacing a shrinking domestic cash cow with this fast-growing international portfolio. But that switch is hurting their margins because of higher payment costs and rev share overseas.
You've nailed the dynamic. It's a necessary but very painful transition. And now we have to talk about why investors reacted so badly. And that comes down to the guidance on the balance sheet.
Yeah, the Q4 guidance really signaled that the domestic problems are getting worse, not better.
That's right. The guidance for Q4 revenue was between RMB 2.52 and 2.62 billion. That range implies a year-over-year decline of between 4.4% and 0.6%. And that's based on 2 assumptions. Domestic revenue falling by mid to low teens, while overseas growth stays incredibly strong at around 70%. The market just focused on that accelerating domestic decline.
And the 2026 outlook pretty much confirms this isn't a one-quarter problem.
It does. Management said that even with an easier comparison base in the second half of 2026, they still expect the domestic business to decline by roughly 10% for the full year. That implies that even if things stabilize on the regulatory front, the platform is just mature and will keep eroding.
That structural decline is worrying, which leads us to the balance sheet. Cash and investments shrank quite a bit. That always spooks investors in the middle of a big pivot.
It does look like a huge drain. The cash balance went from RMB 14.73 billion at the end of 2024 down to RMB 8.86 billion. But, and this is critical, it was largely intentional. It wasn't operational burn. They paid down RMB 4.41 billion in bank loans. They issued a special dividend and they had a big one-off tax payment. So they used their cash pile to deleverage and return capital. But definitely leaves them with less dry powder for more M&A.
And yet they keep signaling confidence with these aggressive buybacks.
They do. To date, they've repurchased 54.7 million ADSs at an average price of $6.23. And they still have over 144 million US dollars left in their authorization. That's management putting its money where its mouth is, telling the market they think the stock is dirt cheap.
Which brings us to our segment. This is not financial advice. We've got this classic scenario. Strong corporate conviction meets a brutally skeptical market. The story investors are obsessed with is fading China cash cow, and they're completely ignoring the multi-pillar global portfolio reality.
The trade thesis here is all about a fundamental mispricing. I mean, that overseas segment, the one growing at 69%, it's basically being valued at 0. The market is pricing Momo purely as a declining Chinese live streaming stock. The opportunity is betting that the transition to a global social and dating company with acquisitions like Happn is real.
So if you go long Momo, what's the anchor that makes this trade plausible, not just a gamble?
The short-term anchor is that share repurchase program. With $144.5 million left and that average buyback price of $6.23, the trade is based on management stepping in to defend the stock price, probably in the low $6 range. You're wagering that the 69% overseas growth is already big enough to start stabilizing the whole company.
That makes sense, but what's the outrageous part of this idea? Because this is definitely a high-risk trade.
The outrageous part is that you are betting against structural regulatory headwinds in China, which is a massive, unpredictable force. You're betting on a deeply cyclical Chinese tech stock with a core business that's in structural decline. You're basically saying that a bunch of apps in the Middle East and a niche dating app in Europe can generate high-margin cash flow faster than their legacy China business erodes.
Right.
That requires flawless execution. It's a huge gamble.
So to quickly recap this deep dive, Hello Group's Q3 is a textbook case of a painful but necessary transition. They are swapping the comfort of being a China cash cow for the complexity and, the potential of a global dating portfolio. The market just reacted to the immediate pain, the domestic decline, the tax issues, the margin hit.
Right. The whole conflict is about the speed of this pivot. Can that 69% overseas growth and smart M&A create a new profit engine before the domestic business shrinks too much and starves the company of capital?
Which leaves a big question for you, the listener, to think about. Does acquiring a brand like Happn really signal that they can replace the Chinese live streaming model? Or are they just chasing a global market with a playbook that might not translate effectively everywhere?
Continue your own deep dive. Ask yourself how quickly these high-growth international platforms can actually become profitable, and whether this pivot can succeed without a stable business back home.
Thank you for joining us for this analysis of the Hello Group Inc. earnings call. We'll see you next time.